Anne heads the Sustainable Financial Capital Markets in Americas for BNP Paribas. Next to her is Apostolos Gkoutzinis, who is Milbank himself. And then after that is Vassilis Kotsiras, who heads the Capital Market and Structured Finance Division of the National Bank of Greece. After this, you meet Mr. Dimitrios Tsakonas, a legendary speaker, if I may say, for Capital Link, who is the Director General of the Public Debt Management Agency. And not last but not least is Ms. Cleo Lymberis, who is the Group Treasurer for the Public Power Corporation. The public debt in Greece rises its beginning since the establishment of the Greek state after the Greek Revolution, that is back in 1821. It was actually the 9th February of 1824 when Greece received the first loan of total amount of £800,000 from an institution in UK. During the years, the European allies have often offered their resources for the restructure of the Greek economy. The idea and the mentality of public lending and public debt lies therefore in the basis of our latter history. Since soon enough, the mentality was spread between private transactions as well, following the tendencies and customs of other economies until the huge bubble of external lending that threatened the sustainability of the state itself. Greece is not alone on this matter. According to IMF, the world's public debt fell from 100% of GDP in 2020 to 92% of GDP in 2022, supported by strong real GDP growth, inflation surprises, and the withdrawal of fiscal support measures related to the effects of the COVID-19 pandemic. However, global public debt is projected to rise again beginning 2023, according to the IMF Global Debt Database and April 2023 World Economic Outlook Database. Therefore, the question that arises is how would any economy thrive and wealth may be produced in the state itself that has open feelings to pay. We are gathered here among very exceptional speakers, experts on the global market to enlighten us with their knowledge and perspective. Let me now give the floor to Anne. Anne, you may start.
Hi everyone and good morning. And as you have heard from previous speakers in the other room, there's a lot of focus by Greece on investments in the energy transition and decarbonizing its main industries, including shipping. In that context, there is a lot of capital available with a specific ESG focus or sustainability focus. In the view of BNP, there's a lot of opportunities that the market will bring in this context. Within Europe, there's 50% of assets under management currently with some focus on sustainability in the Article 8 and 9 funds under the EU taxonomy. And all that money will chase investments that are geared towards either energy transition or other aspects of sustainability. So far, we've seen several Greek issuers coming to market with ESG-labeled bonds, whether it's the utilities with sustainable linked bonds or the financials, the banks with green bonds. Those have all been received very successfully, and that market will only continue to diversify across different sectors. Also, while we await the sovereign to come to market with a potential green bond, we think that in the meantime, ESG directions will be financed by the corporations, and we expect more activity in this market. Thank you.
So, Mr. Tsakonas, would you share with us the challenges and the topics of the sovereign debt so far?
Can I speak? Yeah, you can hear me. First of all, as far as the legendary that you mentioned before, I think that you discovered that I'm too old, indeed. Shortly, I will be 60 years old, but I feel like a teenager. I hope that this is not going to be misunderstood by my wife. Challenges, a lot. But let me start by saying, yes, we delivered. As far as the targets that have been set since 2009, 2010, we have delivered. But the mission hasn't been accomplished yet. The mission is to be back to normality, and for me the definition is to be back to the A+ levels as we used to be almost a decade ago when we decided to jump from the roof. It took a lot of time, but after the implementation of 3 fiscal adjustment programs, consecutive ones and tough ones, finally Greece, I used to say in the past and I still believe in this, is a machine that produces primary surpluses. The most concrete proof of this is that this year's primary surplus in actual terms, i.e. in cash terms, which is something that really matters as far as the funding strategy and the gross financing needs is concerned, initially was 1.6, 1.7 billion. It was revised by 1 billion more, and the final outcome will exceed 4 billion. Next year's primary surplus will be close to 6.9 billion, again in actual terms, and given the fact that our annual actual interest payments for a long period of time from now till a decade at least ahead will be close to 5 billion. This year was 4.8 billion, next year will be once again 4.8 billion. The next mission that should be accomplished, which is a very ambitious one, is the net debt figure being reduced gradually. Net debt means general government debt, the outstanding amount, minus the general government entities' cash reserves. If this happens, if this will happen, most probably it will be an impressive outcome, and you will see a lot of positive reactions in both the primary and secondary market of GGBs. But it remains to be seen. Once again, check my consistency of what is going to happen in the next 2 or 3 years. Now, challenges as far as the funding strategy. We have a challenge. In this environment with a lot of, let's say, a very high net debt figure, unfortunately, Greece has the challenge not having gross financing needs. For the next year, after the early repayment that will take place on 15th of December, i.e. in the next 2 to 3 days, and the LME that took place back in July, we reduced by 3.5 billion the gross financing needs. Having in mind that the primary surplus will fully cover the annual interest payments, then the remaining amortizations, which constitute the gross financing needs for next year, is an amount 3 to 3.5 billion. So my challenge is how to find space for funding activity, especially in a global environment, in Eurozone 1, that the net issuance will exceed the $500 billion amount, euros. In this context, we need to find space, as I mentioned before, for funding activity. So most probably we will continue, first of all, to proceed with early repayments of either official sector debt or private sector, i.e. bonds, or we're going to proceed once again with liability management exercises in the context of bond swap that we have already done, or, which is most probably the first step, due to the fact that it is the easiest one, we are going to start reducing the outstanding amount of T-bills gradually from 12 billion, perhaps initially to 10, 9, 8, 7. This most probably will lead to a steepening of the yield curve. We call it a healthy one, i.e. by reducing the short part of the yield curve instead of increasing the long end. As far as the spreads is concerned, we have seen these historical low levels. I'm referring to the last 10, 12 years period. If you ask me if there will be any kind of how can I say, correction, it depends on investors' appetite. But on the other side, no side effect is going to be faced by the Hellenic public as far as its funding strategy is concerned due to the deterioration of PPP or the QT. On the contrary, I tend to believe that this will facilitate our secondary markets operation and will most probably inject indirectly liquidity to the secondary market. I assume that this should be our target for the next years, as I mentioned before, i.e. to find space for issuance activity, to provide supply here and there by injecting liquidity to various points of the maturity spectrum that we have realized that there are distortions, and to incorporate another new maturity points across the yield curve. In this context, and given the fact that we have done a lot, we used to have a proactive debt management. I can reassure you that for the next decade, as I mentioned before, interest payments will not exceed the 5 billion amount, more or less, actual interest payments. What is going to happen after 2032, which is something like a rumor, a leak, or a fear that everybody afraid of what is going to happen after 2032, most probably a year will follow the 2033 without facing any problem. Why? Because the only thing that is going to take place is an increase by approximately billion of the annual actual interest payments due to the fact that the so-called deferral of interest payments agreement will come to its end, but nothing else will happen since everything has been taken into account into our DSA, debt sustainability analysis. Our debt sustainability analysis is extremely conservative, uses extremely conservative assumptions, much more conservative compared to official sector ones. So I'm pretty confident that the debt sustainability will be there. It is here, there is here, will be there, and no nasty surprises will be provided by our size. In a nutshell, we are done with the numerator of our problem, i.e. the debt. Now everybody should be concentrated to the denominator, the growth, the economic growth. I'm pretty confident that as my job now has become a kind of piece of cake due to the fact that we have in place a government market-friendly, market-oriented that delivers with consistency and continuity, I'm pretty confident that for the next decade, as I mentioned before, nothing is going to happen. And as far as the debt sustainability will be much better compared to our conservative baseline assumption and scenario.
May I ask a question, Mr. Tsakonas?
Yes, please.
On the debt sustainability, I hope I can...
Please do. Feel free.
There is definitely a couple of actuarial reports out there on the longer term regarding potential unfunded pension liabilities that skyrocket after 2030, 2032. Do your projections include pension contributions that will have to be funded by the central government?
Thank you for the question. Although we are not the competent authority, on the other side we have created a lot of buffers, let me put it that way, or translating, let's say, what we used to say two decades ago, wide holes in our assumptions as far as the debt sustainability is concerned. First of all, we haven't followed 100% the assumptions as far as the primary surplus for the next 40 years. By the way, 40 years is the time horizon of our DSA. As the assumptions have been used by European institutions, i.e., instead of saying that we are going to deliver 2.1, 2.2, 2.3% on average primary surpluses, we have assumed that the primary surplus should be equal to the actual annual interest payments. If you do your own calculation, you will be in a position to find how conservative is our assumption. One concrete element of this conservatism is that our outcome in 2060, as far as the debt to GDP ratio, is 45%, compared to 25%, which is the outcome of European institutions. The second white hole that we have created is how we have treated the so-called guarantees, both those that were granted due to the Hercules scheme or those that we call them as legacy ones. So of the overall envelope of 31 billion of both guarantees granted due to Hercules or to those that comes from the vast past, we have assumed that 43% of this amount, close to 13 billion, is going to be called in the next couple of years, i.e. from 2023 to 2030. Please take a look on the others' DSA, if they have incorporated even 1 penny, 1 euro, 1 cent as a guarantee, potential guarantee called. The third is the so-called RRF loans. Although we have disbursed close to 5.2 billion of RRF loans, we haven't, and we have incorporated them to our debt, we haven't incorporated on the other side the asset, i.e. the loans that we lend through the banking system on a pari passu basis to bankable enterprises and companies. And last but not least, as far as the funding costs, future funding costs of the Hellenic Republic for the next 40 years, we have fully followed the conservative or the mainline scenario, the basic scenario of European institutions. According to this scenario, our new cost of funding for the next 40 years on average will be 4.1%. This has two components. 200 basis points is the so-called spread versus Bund, 10-year Bund, and 2.1 is the 10-year Bund on average. Please take a look on spreads. As we speak right now, GGBs are 1.2%, 1.1%, 1.15% versus GDP. By incorporating 200 basis points, you may understand that we have taken into account extremely conservative assumptions. All this to say that although we haven't been focused on the so-called aging population problem, by incorporating all these extremely conservative assumptions, we have created the so-called, as I mentioned before, white holes in order to face all these side effects that may come due either the aging population or the green transmission or additional expenditures due to defense in order to develop, let's say, our defense, etc., etc. I do realize that I haven't answered straight to your question, but in any case, I think that I can provide a lot of confidence by providing you all these pieces of information that I've just done.
Well, thank you for another legendary thesis. Before giving the floor to Mr. Vassilis Kotsiras, let me introduce and welcome Morven Jones of Nomura. Morven, welcome. So, Vassili, let us hear you about what MBG feels like these days.
Thank you. First of all, it is a great pleasure being here again. I started visiting this panel in 2017, and back then, when you had to talk about how the Greek banks would reaccess the debt capital markets, it looked like a Herculean process. But in 2023, we can say that we're experiencing a whole new world. I've been, let's say, a child of the crisis. I left London in 2009 after the global financial crisis. I came to Greece, always a crisis. This year, I'm struggling a little bit to see how it is to operate in a normalized environment. It's not that bad, actually. But we have to say that the Greek system was always within the Eurozone, but always it was in different directions. What I mean, in 2007 and 2008, when it was the global financial crisis, Greek banks were receiving deposits from the Swiss banks. We were, let's say, one of the few jurisdictions that we haven't been touched by the global financial crisis. In 2015, when the Eurozone was announcing the QE, we were announcing capital controls. So totally different periods, and some of these periods were at the peak, and let's say the rest of the world is not in a great shape. But the majority of the times we were, let's say, the outlier in a negative way. This period we are on the positive side. We are one of the best, in my view, financial sectors across Europe, due to the fact that we missed all the years of the expansion and the low credit and cheap money to the market. We have managed to make a much more robust economical system, plus that the banks have balance sheets that they benefit from this environment of the, let's say, normalized rates. For me, I don't think that we are experiencing a world of high rates. 4%, it was what the rate used to be back in 2008. It's not that far away. So Greek banks having a balance sheet where the asset side is mainly a floated form, our loans and our bonds that they are hedged. And on the other side, that our liability side is full of retail deposits. Retail deposits that the majority of the European big banks were trying to decrease from their liabilities because they were punitive in the era of the negative rates. Greek banks are full of them, and we make a very good return for our shareholders. That was not only the best thing could happen in 2023. We had finally the rating agencies coming out of a hypnosis, in my view, especially opposite to the financial sector, and the one after the other competing, who is going to upgrade Hellenic Republic to IG first, and then who is going to upgrade the Greek banks. And that created an euphoria that a lot of the investors that at the past who were not as part of their mandate due to the rating constraints, now they're looking at us and still we look more cheap versus other European banking peers. Not only that, the Emerald target that used to look very improbable to be achieved at the end of 2025, now it is on a totally different verge because first we create big profitability and CET1 through our organic profitability as banks, and that effectively reduces the amounts of efficiencies we need to do. Second, with the Basel IV moving to 2026, we don't need by the end of 2025 to readjust our risk-weighted assets. And the Greek system has shown that in 2022, which was one of the most volatile years over the last decade, we issued 3 billion in total throughout the 4 Greek systemic banks. This year we issued 3.5 billion in much better rates, though. Although that the rates have increased, our rates and the coupons we pay decrease. So we have definitely managed to make a financial sector that can manage accessing the capital markets, as I would say any other within the Eurozone jurisdictions. And this is a big success. My only consideration going forward is that it comes a point where you are very close to get the investment grade as banks, but you don't have it yet. And on the other side, you are becoming priced like an investment grade. That creates an anomaly, as the investors that used to buy you, now you look expensive, and the ones that they want to buy you, they can't till you get the investment grade. So I hope that if we manage this last obstacle, everything at this point seems much, much more optimistic. Thank you.
Thank you so much for this in-depth approach. So let me give the floor now to Ms. Cleo Lymberis so that we can hear the options and the views of the Public Power Corporation.
I'm really honored to be here. I'd like to thank Olga Nicolas Bordozis for having the passion and the longevity to continue this conference over the last 25 years. I moved to Greece 20 years ago, and half of that has been during the Greek crisis. So it's very nice to have come full circle and to be able to speak to investors in the context of an investment-grade country. Before I speak about PPC, Public Power Corporation, which is the largest utility in the country, I just wanted to give some context, which Vassilis so helpfully gave in the context of the Greek banks, but to give some historical perspective of what the Greek corporates had to endure over the last 10 years. And I think what they accomplished is an important testament to where Greece is today. Greek corporates have been active in the debt capital markets actually for the last 10 years. And they were, in the context of the Greek crisis and having no access to capital from the Greek banks, the state being bankrupt, Greek corporates had to adjust and become more extroverted. They had to not rely on the Greek state and had to redesign their whole business plans and become more extroverted. That has created a population of managers that are extremely resilient. Volatility became the new normal for us over the last 10 years. So the volatility in the global markets is something that is pretty much a daily issue for us. So therefore, I think someone who's looking at Greece today in the context of the investment grade should be very confident that whatever investment is made, the people running the show can handle, any weekend surprise, any volatility that may come as a surprise in the strategy. We've built in so much resilience that I think that is something that we don't get enough credit for. In addition, in 2013 and 14, the Greek corporates made a foray into the capital markets that was unforeseen. We challenged the status quo of trying to convince the rating agencies that even if you're in a bankrupt country, it doesn't mean that your company is bankrupt. And in fact, we not only convinced them, but we managed to convince rating agencies that certain companies were worthy of a credit rating above the country that they are domiciled in. At the time, that was completely, it was something that Greek corporates accomplished, and that was something very new for the rating agencies. And our boldness, and of course I'd be remiss to not say that especially international banks that continued to be in the country despite the crisis do deserve a lot of merit here, because they had the on the ground context and experience to know which corporates to support. PPC in 2014 was one of those companies. We did our first foray into the debt capital markets in the high yield space successfully. And of course, I'm sure I won't paint the picture of what happened afterwards, but we did go through a period of extreme volatility and severe distress, similar to the country's narrative as well. With the new management team, 2 years ago, in the span of 2 years, we raised over 4 billion euros of capital, in not only in the debt space, but in the equity space, in M&As, and 2 securitization programs with very high quality investors. How did we do that? It's not similar to what other corporates had done during the crisis. We showed credibility, we showed boldness, we delivered on what we said. We convinced investors that they had to take a leap of faith in light of what had already been accomplished in the last 1.5 years of the new management team coming to BBC. And we had 2 inaugural ratings in 2021 with the support of the Greek banks and our partners, where we were 6 times oversubscribed. We had an international investor base of over 70% international investors, long-only investors that were convinced of our energy transition, of our commitment to decarbonize, and this was something that was a historical record in the Greek market. Today, in 2023, we continue to have a very robust and very ambitious CapEx plan of over 9 billion through 2026. Over 70% is between renewables and the distribution business. We expect around 5 gigawatts of projects to be in the renewable space, and therefore our reliance on diversified capital sources is something that is extremely important. And we continue to look across the spectrum of our capital structure. We are very excited, and in the light of the investment grade upgrade, we feel that the investor universe will further grow. We don't consider it, given where we are in our size and our investor base is very strong, we expect that investors will be looking at along our capital structure on the equity side, on the debt side. We will be repeat issuers. As you can imagine, the Greek banking market certainly cannot absorb the capacity of CapEx that we have, of a 9 billion CapEx program. So we remain very committed to our strategy. We do feel that growth without partnerships is not possible, and you will see that we've done that in various ways. And in addition, Mr. Pyatt mentioned earlier about the Southern Gas Corridor. It's something that is extremely important for the energy transition, and where we need to provide some risk management effects to manage our pricing exposure in Greece. We do see prices coming down as we execute on our renewables program, and just generally our Balkan expansion is something that we expect will be managing that transition.
Well, thank you, Cleo, for this. It was quite enlightening. So let us hear from Nomura now with Morven Jones. What do they think about this? Are we indebted or not?
Thank you very much, and it's great to be here again, and I think it's great to be here at the end of 23, which I think really has been a defining moment for Greece. I'm slightly in a position where my response to all I've heard before is I sort of agree with everyone, because I think it has been a very, very good year for Greece in many ways, but perhaps maybe just to try and pull a few of the comments together. I think it's worth reflecting that it's easy to look back on 23 as a great year for Greece, but it hasn't always been that way, as many will know. And I think that really the output of this year is built on many years of hard work. And I think the word that does come to mind, and again it was mentioned by Cleo earlier, is credibility. And it's one thing to look at the performance of Greek credit spreads this year, or interest rates, as Vassilis was saying, and say, well, it's been based on a trade, if you like, that people have been betting on the upgrade to investment grade. But I think more importantly, it's really been built on many years of establishing credibility, not just with the sovereign. Obviously, the sovereign leads the way, but also with the banking sector and the corporate sector. And I do think that going forward, a very solid foundation has been built in the eyes of international investors around the Greek credit story. And again, I think just listening to many of the speeches this morning, I mean, you sense the energy, the vibrancy, and everything that is going on in Greece, the number of projects that are going on. I mean, you really feel there is a lot of substance underpinning the performance of many of the issuers this year. I think looking ahead, because this is about challenges and opportunities going forward, I think given the strong credit story, and let's not forget that the overall market backdrop is actually quite challenging, whether it's economic or whether it's geopolitical, but I do think that Greece is shining through among investors who have really understood the credit story very well. I think for the sovereign, actually, as Dimitri mentioned, but perhaps not as directly, I think the challenge for the sovereign is less about raising money, but it's going to be more about maintaining liquidity in the yield curve and ensuring that there is an active, liquid, actively traded market in Greek debt. That is going to be very, very important going forward. I think with the banks, again, obviously there's still some upside there, I'm sure, but again, you're seeing how the banks have established a real foothold in the markets internationally. And I think, Vassilis, you'll correct me if I'm wrong here, but I think if you look at most of the bank issues that have come to the market this year, at least 70% of the allocation of bonds has gone to international investors. And so nobody can say that this is really based on the domestic market. Again, staying with the banking sector, if you look at where some of the banks are trading, they're actually trading at spreads which are tighter than some of their peers in Portugal and Spain, and also, of course, higher-rated peers.
I think, Morven, that we would never be able to base our funding plans for MREL on the domestic demand. We're not like Italy. We're not such a developed jurisdiction in terms of asset managers, pension funds, etc. So we had to do it with the international investor base, and I think that this is correctly what you pointed out.
And then finally, I think from the perspective of supply, Cleo, I think if you look at the corporate sector, I mean, we really haven't had any international supply from the corporates, I think, this year in any size. And so again, I think that investors are going to be very keen to see you back in the market when you need the investment dollars.
Well, thank you so much. So we have, last but not least, address the floor to Mr. Apostolos Gkoutzinis, so he can hear his views. Apostolos, you know the fate of the last ones. You have to talk speedily and in a lot of realms. Go ahead.
I think it's safer to be between the bear and its cubs than between lunch and an audience. So I have about 45 seconds to cover the impact of the international credit markets on the ability of Greek corporates to finance their operations.
It's 30 seconds, actually, but that's all right.
A couple of remarks from myself. I think the investment. If you are a treasurer today in a Greek corporate, what should be on your mind? Maybe I can just give 5 passing remarks on the ability of or the opportunity of a Greek corporate or any particular challenges. In no particular order. Obviously, interest rates have risen about 500 basis points in the Eurozone from historically low levels, and the fact that the policy rate has gone up, plus the additional margin, it means that the European credit markets have experienced a huge dislocation. That has been an opportunity for fixed income investors to rebalance, if you like, their interest. And for the first time in many years, fixed income investing has become a significantly more liquid market than before. This trend, as interest rates stabilize into next year, if not going down, I think will give an opportunity to corporate balance sheets to consider their financing plans. There is about 3 trillion of corporate debt in the Eurozone to be refinanced in the next 5 years. That's a lot of refinancing. I think a lot of corporate treasurers dealt with their balance sheets in the years of plenty, 2020, 2021. So actually, contrary to popular belief, most strong European credits are fully financed for the foreseeable future. But obviously, it is a new environment. I think if you talk to the rating agencies, just to get a little bit of a perspective from when things go wrong, credit defaults are rising. So this is across Europe, in particular sectors that are energy consuming, particularly energy consuming, as well as sectors that perhaps have suffered from some COVID-related trends like consumer or retail. So definitely true that defaults are rising. Corporate defaults are rising across all credit rating classes, particularly in the high yield space. So it is definitely true that financial conditions are not benign and will not be benign. What does this mean for our practical, theoretical CFO or treasurer? It means that maintaining diversity of funding sources is key. I think what Cleo is doing with PPC is a good example. They have access to the Greek banks, having established a trusted relationship over decades. They have access to multilaterals. They have access to the international high yield market. Potentially they have access to the local Greek capital market, and I think Cleo is probably getting 3 pitches a day from credit funds, direct lenders, and sort of institutional investors, potentially opening up another asset class. That is really how a properly run corporate balance sheet is looking up in 2023, 2024, as we're going into the new year. It is not an environment that, again, I want to repeat, that is benign, but at the same time there is ample liquidity, and assuming that the business and the operational aspect of the business performs, there will always be credit available to good companies, with reasonable balance sheets.
Okay, great. That was fast. Are there any questions from the audience?
Hi, thanks so much. Maybe just a quick question to my good friend Dimitrios Tsakonas. Greece has now left the below IG club, and what I was wondering is, what challenges does this bring for you as a debt manager? Of course, the peers are now different. The benchmarking markets and other credit assessors will do is different. Of course, you mentioned we're looking up, but what does this mean now for Greece being in that IG club again, where it has to not just compete but really look up to other countries? Are we going to be judged more harshly now than being the, let's say, the top kid in the below IG club? Thanks.
Yes. The answer is yes. Although we changed, now we belong to the so-called Premier League, not forget that we are to the bottom of this league. That means that, why, I'm just thinking loudly, why someone to buy, let's say, GGBs instead of BTPs or others, take into account how that the whole Greek yield curve is inside Italy 50, 60 basis points. What I'm waiting is most probably due to the net supply that will be provided next year. This will be the challenge for all the Eurozone partners. Most probably a widening of the spreads will take place, not only of Greek spreads, all the periphery versus Germany. In this context, but again this is a bet, and it remains to be seen if this will be the case, I'm pretty confident that our spread will be wider compared to today's level, but the widening will be slightly less compared to others. Why? For the reasons that I mentioned before. My problem is mainly to find space for funding activity. It's a good problem to have. Usually we had the opposite problem. A lot of needs, nobody wanting lending us money. Now we have, let's say, gross financing needs that for the next 40 years will not exceed 5% of GDP, compared to our beloved neighbors. As we speak right now, they have 20% of their GDP gross financing needs, and the average in Eurozone is 10% of GDP. But still, a lot of challenges, indeed. The good thing is that the gross financing needs should be increased up to the levels that the newcomers, either the passive investors, indices, etc., or gradually new investors that will be gradually more familiar with the GGB story, with the Greek story and the GGB market. We are here in order to follow and to satisfy investors' appetite. Once again, our funding strategy will be investors and market-oriented. Nothing spectacular, nothing that will provide nasty surprises to anybody. On the contrary, most probably positive surprises will be provided by our side.
So it's time. I'm sorry, there is always time restraints. Thank you for listening to us today, and hopefully we're going to see you next year. Thank you so much.